All right, welcome. So in this video, I want to cover off. It's kind of on a whim, really, but I feel like it's a really good topic, and it's been on my mind, so I wanted to cover it off. And I'm going to split this into two videos, and the first one I'm going to cover off today is some of the key mistakes of intraday traders. Right, so anybody who's scalping or potentially trading level to level, I want to look at some of the key mistakes that those traders make. And again, please remember that I'm always speaking from personal experience. So when I say that they make, right, and somehow sort of it seems like I'm excluding myself, well, I kind of am. But at the same time, this is the journey that I've been through as well. So what I am referencing here are my own experiences and my past experiences, and a way to hopefully allow you to improve and learn from. So what I want to go through are some of the key mistakes that newer traders will make when they're looking at lower time frame plays. And I'm basically just going to choose like this random selection of things, right? There's no real kind of consistency or order to what I want to go through. It's really just a case of running through a list of things. And just give me 1 second, because I've got to just sort out some positions here so I'm not distracted into this video. Okay. So what I want to talk about first things first is I'm going to refer to kind of intraday traders. So what I'm talking about here is lower time frame traders, 5, 15 minute, the hourly potentially even. So somebody who's looking at operating on their trades on a day-to-day basis, and looking into some of the key mistakes and some of the areas you can look for automatic improvement in your trading on those time frames. And this kind of really doesn't matter on the system or the thought process. It's really just a case of kind of some of the psychological points, or just some of the generic points that come into play and you're able to change. So let's start off over here, and let's just type these out and go through a couple of examples. Okay, so number one, okay, is holding the trade too long. So this is a classic from intraday traders. Intraday traders have a tendency to hold on to trades for too long. So what happens is we see a large increase in price, and your entry was down here, and we get to up here, and you don't know what to do. Okay, so what happens is your original trade, regardless of you having a take profit or not, turns into, what do I do? All right, what do I do now in this region, now that we're up here? Do I hold on to this position? Do I cut this position? Am I supposed to take profit? Okay, and we get ourselves into a situation where we're kind of in this unknown all of a sudden. Right, we don't know what we're supposed to be doing anymore. If we're supposed to be getting out of our trade or what. And this situation commonly develops because we tend to get greedy. Okay, that's the primary reason that this happens, is because greed tends to take over. So we tend to hold on to our trades for too long, because what starts happening subconsciously or consciously is that we start thinking about more profit. And especially in the space that the majority of you are involved with crypto, all right, it's because the moves can be very aggressive. And so if you long something and it goes up 4 or 5%, immediately in your head you start thinking about 7, 8, 9, 10%, right? Maybe even more. And you're happy with your entry, right? Which means that you're now in a position where you're facilitating the greed. So you're facilitating that aspect of greed and allowing it to be there. Now, there are a few points around this, okay? Number one is, it might not be the worst idea. Right, so I'm starting off this by saying this is a problem, but it might not be the worst idea. If the market conditions support it, and we'll look at that in a second, it might be okay to hold on to a trade. But we need to have clear boundaries on what that looks like. And so let's go into that first. So in this example here, we've got a trade that we took down here. This is our entry down here. And we've moved up to this high over here. Maybe I should use live price for this, just to give us like an example on ETH here. So like, let's just use this as an example point. Like, let's say that you got in here, okay, and this is your long position here, and you've managed to hold all the way through. Actually, let's say that you hold it up to here, okay. Let's say this is the trade you take, because I like this. This is a nice area to work with. So what happens is ETH moves, and ETH moves really, really nicely, okay? And let's imagine you're in a position from here. Now, what happens when we get 3.5% up, and especially when we're looking near the kind of all-time high region that we're looking at over here, okay? We start to get that element of greed that kicks in. Okay, so we get that element of greed. We're getting up towards the all-time high regions. We're feeling really confident and really aggressive, and we want to hold this trade through. And we start almost transitioning this trade into a swing trade when it is just an intraday or a scalp trade. All right, so that process starts taking place in our head in what we're doing here. So what's important is to assess that and analyze that and acknowledge that that's what you're doing. Okay, you are trying to turn a trade into a swing trade. Now, the first thing that should be immediately obvious to you in this example is, like, this is not a good position to have a swing from. Okay, this is not a good position to have a swing from. The reason that's the case is I'm not playing any significant breakout region like this, right? I'm not playing any significant higher time frame breakout region and hoping to swing from there. I'm holding on to something that's mid-rally and is a perfect scalp point to play the next leg higher, but it isn't necessarily a good swing entry. So always when you're thinking about this, take that as your first consideration point, right? Is the point that I am long from, can that support a swing entry? If you've longed because it broke a 5-minute consolidation and you wanted to catch the next leg, that's not a good enough base to have a swing entry from. Right, I hope that makes sense, right? You want to have a swing entry established from a higher time frame position breakout. So even if, for example, we were looking at this region over here, we could be looking at lower time frames to try and time an entry out of here. Right, so we could be using the 5-minute to try and catch this, which is fine. And it gives us a far better region that may support a swing entry than just midway up a pump here. Okay, and so when you get into that position, it can then start to lead you into, like I said, thinking about holding on to the entry. Okay, so first thing is first is think, does my entry support the fact I want to hold on to this position? In the majority of cases, that will absolutely be a no, and therefore you're already setting yourself towards the I should be taking profit side of things here. All right. Because if it cannot support a swing entry, why are you holding it instead of banking your money? Right? Why are you holding it instead of moving on and banking your money? All right. So that's the first thing that you can do to overcome this. All right. So think about this. Think about where your entry is taken and think about taking profit as a result of that if it does not support it. The other thing that you can look to do is if you want to start getting into the habit of being as aggressive as possible. So like, let's say, for example, you take this ETH trade, but you're like, I don't really know where my target is. I just kind of want to try and ride it because ETH has broken out of here. So what I'm going to do in this instance is I'm not going to swing trade it. But what I'm going to do is I'm going to try and ride the trend as long as possible. Okay, that's your thought process is I want to just ride the trend, because if we have one of those days where ETH goes and does a 15% day and I caught this, I really want to push that as hard as possible. So this is where I was saying before, sometimes this thought process is good to have, right? Because it means that we can take a more kind of aggressive attitude into the scalp. Now, with that in mind, and this is a conversation I've been having with a one-to-one student this week, okay, there's a compromise. The compromise is you can either take profit at a point that you have specified, and again, that can be because financially it looks good to you, right? If you've gone and bagged $1,000 in 5 minutes, that's a pretty good money, okay? Or what you can do is take profit because you've reached your target point. Right, so if you're a divergence trader, for example, and you play a 5-minute divergence and you get a big spike up in price and RSI now reaches into the overbought regions, or maybe even causes a divergence on the other side, right? If you longed a bullish divergence and it now forms a bearish divergence, that's usually enough of a trigger to say I should be getting out of the trade. But let's say your system doesn't give you an exit trigger and you're not happy with the profit. Right, you are feeling a little more greedy on this day. If that's the case and you want to consider kind of, being more aggressive on lower time frames, then what you have to do is you have to follow the trend higher. Right, so you have to follow the trend higher. And this is where the compromise comes in. Because when we follow the trend higher, we are not taking profit at the optimal point, right? We have to acknowledge that. We will never ever take profit at the optimal point if we choose to exit the trade on a break of lower time frame trend. And the reason that that's going to happen is because any break in lower time frame trend is gonna mean that we have lower prices. Especially, obviously, I'm talking about this from the long perspective. Okay, so it means that we're going to have lower prices. So we're never going to exit the trade at a optimal price point in terms of profit, but we will have potentially exited at the optimal point for protecting our position and maybe for a change in trend on the lower time frame. So we can see in this example here, if we were to take this long from here, what we could do is as soon as we get this bounce to a fresh high here, we can slide our stop up to here. Okay, because now we want this low to be protected. And as long as this low is protected, then we're fine staying in position. Okay. And then what happens is we bounce down and we make another high here. So now what we can do is we can slide our stop up to this low. Okay. And so what you can see here is that now you would have been stopped out. All right. So what you would have achieved from this trade is you would have achieved from your entry here to here. So 2.5% you would have got on this trade, right? Nice and clean. 2.5% before price comes all the way back down to your entry. And for the majority of you, I would suspect is the point that you probably end up closing out this trade. Because you hold on, you hold on, you hold on, you hold on. It dips down, you're okay with it, right? And then gets down here and you probably close out somewhere in this region. In which case, following the market structure up is a far better solution for you. Because it means you get out here at 2.5%, which is at least going to bag you some profit. But you see the downside to this, okay? If I just choose to take profit here, potentially on a divergence or an overextension, right? So if I look at this and I say, well, here's the overextension I'm now going to get out on this second leg for, then I'm going to get that, squeeze that little bit more profit out the position. Now, again, this is a balance because there's sometimes where your trend, right, is just going to do this. And you're going to slide your stop, and you're just going to be protected the whole way up. And in which case, you're going to outperform the fact that I chose to take profit here. So it's a balance, and you have to figure that out in your trading. But you cannot simply turn your scalp into a swing, right, just because you get greedy about price going higher. If you're taking it on a low time frame, you use the lower time frame in order to think about where your exit point is. Okay, I hope that makes sense. Right? You think about where that exit point is and you action when the exit point is triggered, whether that be just the straight up profit being hit, target being hit, market structure being broken, signals within your own system or thought process that have been triggered, right? Whatever that is. So that's one thing that people tend to do, and it's like a really big one, especially for intraday traders, is the greed element of holding on to positions for too long without any plan. Right? And very important, without a plan. You need a plan. Okay, you need a plan for the lower time frame stuff. Okay, so that's point number one. Christ, that was a long explanation for point number one. I didn't think I was going to go that long with point number one. The second point is getting caught up in chop, right? And this is going to be a classic one for a lot of you guys, right? Getting caught in chop. Now, where this usually stems from is an eagerness to join in. So this can be because price is accelerating quickly or selling off quickly. And there's an urgency and a need to get into position. And we speak a lot about kind of dynamic scalping on lower time frames, just using momentum, you know, RSI, diagonal breakouts, etc. And sometimes you need to be aware of kind of when that is going to serve you well and when it isn't going to serve you so well. So like, for example, on ETH here, like this is a day where we have some like kind of pretty nasty price action, and we'll see if we can get any levels in here. All right, so like here's a classic one. Okay, here's a classic one. So what you can see here is that ETH is selling off. Okay, we get down to the lows on RSI from my perspective, but let's just ignore RSI for now for those who don't use it. So we sell off down here, and we break what looks like a diagonal here, bounce, and this is where a lot of people would enter into long positions on lower time frame, before eventually we just turn around and would stop you out. Okay. And like, here's another one, right? Here's another one. People may have a diagonal drawn like this, right? So they say, okay, well, price now, we can see maybe even this, right? Something like this. Just to say, okay, well, we're bouncing in between these two levels now. Here's the breakout, right? Turn around, stopped out again. And when you look at this, okay, and like come out slightly, like ETH has been moving in a relatively decent range, but you failed to acknowledge two things in this region if that was your style and if you were kind of in agreement with me on my thought process there. You failed to appreciate two things. Number one is relatively choppy day, right? Largely like a kind of sideways position through here when we start to zoom out. The second thing is if we do start to zoom back in and look at this region, this is trending down. Okay, this is trending down. This is not trending up. All right, so what we look for is we look to enter diagonal breaks when the market is trending up, not when it's trending down. So a situation like this is when we're almost over-eager to enter into the positions. And again, I'm talking about kind of the pitfalls of the long side at the moment because that's primarily the market we're in, right? Most people are trying to get long. And so this over-eagerness to trade and to enter positions and to monitor for breakouts often leads us astray. Because what we start to do is forget things like ETH is trending down, right? We tend to forget the fact that ETH is just actually selling off all day. So from here, this is the classic Asia session that we experienced, right? 11 o'clock here, all the way through till 12 o'clock the next day, 2 o'clock the next day, we just sold off. We just continuously sold. But when you're over eager to enter a trade, you can sometimes find yourself moving against the trend unintentionally just because you haven't even thought about it. Right, so very important. We take our diagonal breaks when we have price that looks like this. Right? Consolidation, 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 consolidation. Diagonal, strong uptrend, breakout, long the next leg. Right? That's our classic structure. Our structure for long in the diagonals is not something that looks like this. Okay? Because we don't want to get involved in a diagonal breakout of a down trending lower time frame chart because we're going to get faked out a lot. Right? So just pull back on that over eagerness. And so kind of to that point, the over eagerness, right? And the kind of underpinning point about this. When the market is doing what it's been doing, in terms of the aggression to the upside, really important that you manage your positions. All right, so when we're talking about managing positions, what I'm talking about is making sure that you're not just going like 100% of your entry straight away. Giving yourself breathing space. Okay, so this concept of the over-eagerness to join in on trades usually just leads us just to say, okay, well, bam, I'm just going to market by 25 ETH now, thank you, done. And that's not a great situation to be in because it puts your scalping or intraday trading in a really awkward spot because you have one entry. You have one entry. And if you're using kind of, your risk and reward and you're using appropriate risk management, then you'll determine your potential risk and where your stopping point should be, right, for the invalidation point. But taking your position size all at once just locks you in. There's no flexibility that you have in your position. One of the biggest breakthroughs that I made in my trading was being completely fluid with my position building. All right, being completely fluid with that position building and not having just one position all at once to just smack in and say that's it, done. So like we'll take the S&P example from where I was trading this week, okay? So I went through this on stream, but it's important to just note where we are here. So this is a region I was hoping would act as a resistance point through here, and we can see this on the hourly. And so, I was eager to get into a trade. I was anticipating and looking to get into this position when we were approaching this area. But then I have to kind of put the trader's hat on and just get into the zone of thinking how I want to try and play this region. So what we have through here is a 15-minute divergence, right? So I'll give you kind of the view from my side. So what we were looking at here is a 15-minute divergence across the highs that stretched all the way through here. All right, so this high, and these highs. Stretched into a big 15-minute divergence. Now, what a lot of people will do in this situation is they will look at the first divergence that forms here. This is the confirmation point here. And they'll take 100% of position here. Now, what that means in reality is that, number one, you were eager to get into the position. You were too eager, and you pulled the trigger too soon. Because what will happen is price will creep up like this, and you'll close the position. So you'll probably end up market closing this position somewhere up here. And then what you'll do is you'll probably re-enter at market somewhere back down here. And so you've cost yourself money through this region instead of strengthening a position. So you can see the way you play this entirely wrong if this is what you would have done in a situation like this. Because what you've done is identified that, yes, this is a divergence. This is resistance. We're diverging into resistance. But because you were eager and you took all of your position at this point, you got nervous by the time we crept up a few dollars more here. All right, which means you would have marketed out. And then at this point, you would have said, oh shit, we are going to go down actually. So I'm going to re-enter now at market over here. Whereas now, if you take that logic and slow things down in your mind, and you say, okay, we're building the divergence, and I've got the first confirmation point here, it's time to open a position of 50% here. Okay? And then what happens is, we slide up a little bit higher. You've only got 50% of your position, so you're chilled, you're not too worried. But your mindset has changed, because now you are not defensive as we get up here, thinking, shit, please don't go any higher. You're not defensive in your mindset, you're aggressive. So you're instead looking at this region, you're saying, aha, you are still diverging up here. Time for me to take another 50% of my entry and get this 100% now filled. Okay? So you see the way that just viewing this slightly differently changes the whole attack of this process. So we're now no longer defensive, worrying that price is stalling, and this stalled for an hour and a half. Right, so this was not a quick turnaround up here. Right, this stalled for an hour and a half at this point. And so by changing your mindset and taking a smaller entry and adding to the entry, you stop being defensive and you start being aggressive. And as a result of that, you save the cost of you marketing out of the trade in the middle and right at the top, and you actually get yourself a better entry. So you can see, like, this is my exact trade that's currently on screen at the moment. Right? And the reason that my entry is where it is because this is exactly what I did in this region. Okay? I sold, and then we turned around. So I didn't have any worry about the position. I didn't have anything that I needed to be overly concerned about here. I just kept selling into it in small amounts, right? That's my personal preference, is I take smaller than 50%. I'm using that as the example. But it changes the mindset from defensive to attacking and aggressive. And I'm looking at this with excitement, not nerves anymore. Because all the time, I'm potentially getting a better entry point for a short. So every time I'm bringing up my average, right? You push higher, you still diverge, I take more. You push higher, you still diverge, I take more. Okay, I'm seeking out that play. I'm not defensive and worried that I entered too soon and I'm now being shaken out near the top. And so with that comes time, right? That links into time. So what we've done is we've gone from greed and scalp trades into swing trades. We've then started to look at over-eagerness and the way that we can miss the clear signals of trends. Okay, we've then gone into over-eagerness and the way that that changes our defensive versus attacking mindsets. Okay, and now we're going to look into time. Okay, and time that links into that. Because time is very, very important when scalping. And it's the same when swing trading. Time is very important in trading as a whole because we tend to have a very warped view of time. When we're trading, we expect things to happen instantly. We expect candles to moon or doom on our command, right? And as we're sitting there staring at them and watching, I'll stay with the SPX example because it's very good. And that's not the way trading works, and that's not the way scalping works. Unless you are down on a tick-by-tick chart or a 15-second chart, you should not be expecting instantaneous moves. If you are sitting there with a 5-minute chart, which I would say is probably the average for what most people I see in the group doing intraday trades would be using, you cannot expect an instant response. So in this example here, when we don't get a play out from the divergence here, people start to worry, which again starts changing their mind. And so if we put it together with what happened previously, you enter 100% of your position, we don't sell off, right? We spring higher. So you're worried now because we didn't sell off when you thought we were going to. And we spring higher. That, you are completely on the defensive. You are completely on the back foot. Because your expected situation did not play out by selling off here when you thought we should have. And we went higher past and above your entry. So you are completely on the back foot in this trade. Now, if you remove the time element and you say, look, I'm seeing the signs here that this is weakening, but I am under no control whatsoever for the market to behave and respond on a time frame that I dictate. Because that's the truth, right? We have no say over when the market does something. We'll cover that a little bit more in a second in an elevation to that thought process. But we have no time control over when the market decides to do something. So, in this example here, a lot of people would have sat here nervously and closed their trade and been in and out of multiple trades because this was 3 hours. Okay? 3 hours of us consolidating at this high. So you see what's happening here. Okay, when we anticipate things and when we think things are going to happen because we see a divergence, because we see something in our own system that indicates we're going to go down, everything starts to speed up. Everything now becomes a case of, well, you should be going down. You should be going lower. Why are you not turning around? Why is this not going the direction I thought it was going to go in? Right? You see all the way that these different things start to play out, right? So get rid of time as a thought process completely. In this situation here, the only thing you should be focused on, if you are playing a similar system to what I would be playing here with the divergence, is the divergence still present? Yes, it is. Okay, I'm fine to stay in my position. Doesn't matter about time that's elapsed. Okay, so it's a really important one. Don't ever put time expectations on your trades. So we covered off another number of things in this video. And we'll quickly recap again, just to make sure everything is covered off and I'm happy with what I've spoken about. Number 1, scalps versus swings. Do not turn your scalps into swings. Right? If you have a very good base from a scalp position, because it plays out of a higher time frame break of something, maybe a breakout play or a support bounce with a divergence on a higher time frame support, fine, by all means, maybe look to see if that's something that you can try and facilitate a slightly wider play from. Other things to do is utilize lower time frame market structure if you want to try and push your trades aggressively in the current market conditions, right? When we see stuff like uni and sushi doing 10-20% a day and you want to try and catch that, then look at moving up and following market structure. So that allows you to be a little bit more greedy, but have a technical backing for the reasons why you're doing so, and an invalidation point for when you'll get out of that trade. Okay? If you adopt that thought process, it's going to have a knock-on effect to the area you take profit, because like I said, it's always going to be lower, potentially. For the majority of you, it will be lower. But it will be technically a correct decision. And that applies incredibly strongly to the lower time frame stuff. Second point in here was being too eager to get into the market and start drawing things and identifying things that are missing the core underlying kind of facts. So like the big one that I covered off was drawing diagonals in downtrends, expecting the breakouts to be strong. Right? We look for diagonals in strong uptrending markets with consolidation, not things that are trending down. But very often when we're overeager and we're excited by what we're seeing in the markets, we're too quick to jump into trades. So we start forcing ourselves to hop into these positions because to us, it looks like a diagonal break, right? And we've seen potential effectiveness with them previously. And we look at diving in. So not good. When we miss the key signals about trend, about chop, because we're looking at drawing things like diagonals and playing momentum incorrectly in those instances. Okay, and then lastly we went on to the psychology around attack versus defense and building positions over time. So continuing the over-eagerness theme and instead looking more at a building theme. Right? How do we build a position and how do we switch that mindset from defensive to aggressive? How do we stop being defensive and worrying about positions and instead looking at being aggressive and attacking and building positions when we see price in a region that's of interest for us? And then lastly, we had the discussion on time. So why time is important to not consider when we're trading, and certainly to start pinning our thought process or our hopes on and potentially changing our mind and our decisions. And we see the way that links in with the previous conversation about defense and attack. All right, so I hope that this video has been helpful for anybody on lower time frame. I hope there's some things for you to think about in your own trading and potentially some of the traits that you demonstrate. And I hope there's also some helpful advice in bringing that out. A lot of you may just be doing this kind of subconsciously and never really stopped and thought about it before. So I hope this video has been helpful, and like I said, I'm going to be doing 2 of these videos. So this is the first one. The second one's going to be focused on swing and higher time frame positions and looking at the changes and the differences and the mindsets needed there in order to operate effectively on those time frames. So let's end this video here. I don't know how long we've been. I'll find out shortly. 33 minutes. So I hope everybody took value in this, and if there's any questions, as always, either just send me a message in the Chill Lounge, or you can tag me in the Ask CBS channel, and I will get back to you there.